You've been lied to. Wall Street doesn't want you to know this. They built an entire system designed to make investing feel complicated, so you'd stay broke, stay confused, and keep your money sitting in a savings account earning basically nothing. But today, we're blowing the whole thing wide open. I'm handing you the exact step-by-step blueprint to pick winning stocks like the pros. And you don't need an MBA, a brokerage firm, or a trust fund to do it. Let me show you the right way. You're watching M3 Money Mindset Makeover. This isn't just a channel, it's a mindset revolution. Learn how to break free from the cycle of debt and build a secure financial future, not just for yourself, but for generations to come. Subscribe to Money Mindset Makeover and hit the bell to join the financial revolution, my M3 Mavericks. And stick around, because today, we're cracking the blueprint that can take you from broke to baller. We're talking about the stock market for beginners, step by step. No jargon or fluff. Just real financial education on how to pick stocks like a pro. Starting right now, so let's dive in. Okay, let's set the scene. It's 2026. Rent is eating half your paycheck. Gas is being dramatic. And your savings account is out here flexing a 0.01% interest rate like it's doing something. Meanwhile, the S&P 500 has historically returned around 10% annually over the long run. The gap between where your money is sitting and where it could be working for you, that's not just a wealth gap, that's a knowledge gap. And knowledge? That's exactly what we're filling in today. Investing isn't some mystical dark art reserved for Wall Street suits. It's a learnable skill. And once you understand the basics of picking stocks with intention, not impulse, you unlock a level of financial power that most people never discover. So let's break it down into 4 real, actionable steps. Think of this as your investment checklist, your personal roadmap for profitable investing and smart stock evaluations. Step 1. Become a value detective. Okay, imagine this. There's a fire sale at a luxury car dealership. Ferrari's at half price. Sounds like a dream, right? But here's the thing. How do you actually know if it's a deal? Because a Ferrari that's been totaled and rebuilt is not a deal, it's a trap. Same thing happens in the stock market every single day. A stock looks cheap on the surface, but is it actually undervalued? Or is it falling apart from the inside out? This is where valuation ratios come in. These are your financial detective tools. They help you see past the hype and understand a company's true worth. Here are the 3 big ones to start with. The PE ratio, or price to earnings ratio. This tells you how much you're paying for every dollar a company earns. A company with a PE of 10 might be a steal compared to one with a PE of 40. Lower PE? You're paying less for more earnings. That's the whole game. Then there's the price-to-book ratio, or PB. This compares the stock price to what the company is actually worth on paper, its assets minus its liabilities. If the PB is low, the stock might be undervalued compared to what the company owns. Think of it like buying a house for less than its appraised value. That's a win. And finally, the EV/EBITDA ratio. This one sounds intimidating, but it's just a fancy way of measuring operating profitability. It takes a company's total value and compares it to its raw earnings power. This is great for comparing companies across industries, apples to apples, not apples to Ferrari dealerships. M3 Pro Tip: tools like Tickar Terminal make this kind of research incredibly accessible for beginners. It's like having a Bloomberg terminal without the Bloomberg price tag. Step 2. Find profit powerhouses. Cash flow is king. But here's the real twist. A cheap stock doesn't mean a good stock. You want companies that are actually making money and rewarding their investors for believing in them. This is where return on assets, or ROA, becomes your best friend. It tells you how efficiently a company uses what it owns to generate profit. Let's make it real. Say Company A bought a restaurant for $2 million. It earns $200,000 a year. That's a 10% ROA, solid. And they pay dividends. They're literally paying you for owning a piece of their business. Now, Company B bought a restaurant for $4 million, also earns $200,000 a year. That's a 5% ROA, half as efficient. And they keep all the profits for themselves. No dividends, nothing. Same revenue, yet wildly different stories. Company A is the move. Always look for companies that not only make money, but make money efficiently and share the wealth. That's profitable investing with purpose. Now hold on, because this part matters. Let's get real for a second. You didn't grow up learning this. Nobody taught you in school what a PE ratio was. You were taught to study hard, get a degree, find a job, and, if you're lucky, maybe put a little into a 401k and hope for the best. And then reality hit. Student loans that feel like a second mortgage. Rent going up while wages stayed flat. The hustle culture trap. Working 2 jobs, barely sleeping, and still behind. The system didn't fail you by accident. It was designed to keep you consuming, not investing. To keep you working for money, not making money work for you. You're not lazy, you're exhausted. And the system, it quietly profits off your burnout. This is an M-cubed staple because it's not just catchy, it's real. And it needs to be said on repeat until it clicks. Most of what you're feeling isn't a character flaw. It's autopilot survival mode. It's constant notifications. It's comparison culture. It's inflation, pressure, expectations, and the silent weight of do more, be more, earn more. Sometimes you don't even realize what's happening until someone grabs you by the shoulders and says it out loud. You're not unmotivated. You're overloaded. And once you see it, you can finally stop blaming yourself and start rebuilding your energy, your focus, and your mindset on purpose. That's what M-cubed is about. But the moment you learn to invest with intention, the moment you start buying assets instead of just paying bills, the whole game changes. And that shift? It starts with knowing how to evaluate what you're buying. Have you or someone you know ever lost money because of a bad stock tip or financial advice that didn't work? Drop your story in the comments. Your experience might help someone else avoid losing their hard-earned cash. Step 3. Consistency over hype. Stop chasing fireworks. Everyone wants to find the next Amazon or the next Tesla, the next stock that 10x's and makes some 22-year-old a millionaire. I get it. But chasing explosions in the market is how you end up with smoke and empty pockets. Remember Biogen? The pharma company that was skyrocketing, where everyone was hyped, and then suddenly the growth just stopped. Investors who chased the hype left holding the bag. We're not here for fireworks. We're here for consistent profitability. We want companies with a proven track record of doing the same thing well, year after year. Companies that have demonstrated the ability to turn assets into profits consistently are far more likely to continue doing so. That's how you build long-term wealth, not by gambling on hot tips, but by investing in proven businesses. This is the invest pillar of our M-cubed framework in action. We don't speculate. We evaluate and we invest with evidence. Step 4. Do your homework. Become an informed investor. Now hold on, because this is where most beginners skip a step. They find a tool, run a screen, see some pretty numbers, and buy. Don't be that person. Real investment research means going deeper. Here's your investment checklist for thorough due diligence. First, dig into the financial statements, balance sheet, income statement, cash flow statement. These aren't just accountant documents. They're the truth about a business. The income statement shows you if they're growing. The balance sheet shows you if they're stable. The cash flow statement shows you if they're actually generating real cash, or just playing accounting games. Second, listen to analysts, but think for yourself. Financial news and analyst reports can give you useful context. But analysts can be biased. Ratings can lag reality. Read multiple sources and compare opinions on both sides of the aisle. Challenge assumptions and think critically here. Future you will thank you. Third, follow the insiders. When executives and board members are buying their own company's stock, that's a bullish signal. They don't buy their own stock when they think it's going down. Track insider activity on platforms like Tickar. It's often one of the hidden gems of stock research that retail investors totally sleep on. Fourth, stay current. Earnings calls, news releases, industry developments. Things change fast, and if this is new, I's fine. Get good at 1 or 2 of these and lock in. A company that looked great 6 months ago might be facing a major headwind today. Subscribe to Financial News. Follow reputable analysts and stay in the know. Bonus point, industry matters. Are you betting on the right horse? Before you commit your hard-earned dollars, zoom out and look at the industry. Not all sectors are created equal, and even the best company in a dying industry is still in a dying industry. Ask yourself, is this industry growing? Think electric vehicles, renewable energy, AI, e-commerce, biotech. These are sectors on an upward trajectory, driven by technology shifts, regulatory tailwinds, and changing consumer behavior. That's where the hidden gems in the stock market are buried. Ask yourself, how competitive is it? A fragmented industry with no dominant players? That's opportunity. A market controlled by one or two giants? Harder for smaller players to break through. Ask yourself, what does regulation look like? Stricter environmental rules could crush fossil fuel companies but launch renewable energy stocks. New healthcare regulations could hurt pharma margins but boost telehealth. Understand the landscape before you plant your flag. If you're feeling this right now, stop scrolling. Unsubscribe from broke and become the CEO of your life, starting today. Hit subscribe so you don't miss what's coming next, my M3 Mavericks, because your bank account will thank you later. Here's the mindset shift that changes everything. Rich people don't get rich just because they work harder. They get rich because they own things. They own pieces of businesses through stocks. They own real estate. They own assets that generate income while they sleep. And here's the beautiful, rebellious truth. The stock market is one of the most accessible wealth-building tools ever created. You don't need to be on Wall Street to own a piece of Wall Street. You don't need $10,000 to start. You can begin with $50. The key is to begin with knowledge, with a plan, and with the right financial ratios guiding your decisions. That part is important. I would maybe rewind that to catch it again. This is where broke ends and ownership begins. When you understand how to use financial ratios, PE, PB, EV, EBITDA, when you know how to read a company's cash flow, evaluate its consistency, research its industry, and follow insider activity, you stop gambling and start investing. That's the shift. That's the power move. Our M3 4 pillars are save, invest, earn, and budget. Today we went deep on invest. And this is just the beginning. The more you learn, the more powerful your financial future becomes. All right, M3 fam, let's bring it home. Today you got the full blueprint. 4 steps to start picking stocks like a pro. Step 1. Become a value detective. Use financial ratios like PE, PB, and EV/EBITDA to evaluate if a stock is truly undervalued or just looks cheap on the surface. Step 2. Find profit powerhouses. Look for companies with strong ROA and shareholder-friendly practices like dividends or buybacks. Efficiency matters. Step 3. Consistency over hype. Skip the fireworks stocks and hunt for companies with a proven, repeatable track record of profitability. Boring wins in investing. Step 4. Do your homework. Dig into financial statements. Follow insider activity. Read broadly, and stay current on industry trends. The more informed you are, the better your investment decisions become. And always, always consider the industry. Even the best stock in a dying sector can drag your portfolio down. Bet on the right horse and the right race. Although this is a beginner's guide, and I realize some of this may not stick, but at the very least, if you've only learned how to evaluate a company, like when you stop reacting to headlines and simply start responding to data, you level up in a way that changes not just your bank account, but your entire relationship with money. You're not just learning to invest, you're learning to think like an owner. And once you start thinking like an owner, the whole world looks different. My next video was an absolute blast to research and may just open up your eyes. How many people are actually millionaires? Stick and stay, I've got your back, M3 family. Subscribe to the channel and see you there.